Good afternoon, everyone, and thanks to the organizers for having us here. We are going to talk, and I'm going to talk for about 10 minutes or so, and then let Kaushiki do the heavy lifting around here. We are going to talk about one sector in one country, microfinance in India. And as when Kishan invited us to write this paper, we were like, all right, this is interesting. We have done some work in microfinance before. We took it as an opportunity to give a broad overview of the sector in the country rather than really trying to make any particular point. But the story that when we look at it very quickly became a whole saga. And like everything related to India, it's never either conclusive or simple to tell. So there are all kinds of things that started coming into the story. It was interesting, at least from our point of view. And I don't know whether our telling of the story will leave you with the same feelings or not. So this is how we want to tell the story. So I'll just take probably a couple of minutes to connect the microfinance sector to the broader financial inclusion agenda, which is the theme of this conference. And I'll just spend one slide on that, and then give you a very broad overview of the state of things in the microfinance sector in India. And then Kaushiki will walk us through the journey of microfinance sector in India. And it's not that we just want to share this story simply because of the history, but the journey of this particular sector in India has been pretty unique. I mean, I know every sector in every country is unique in some way, but this story, I think, we think that this really points to certain political economic dimensions of the sector. It's not just an economic story. It is punctuated by political overtones in many places, and the place where the regulatory side as well as the political side is engaged with the pure economic and financial intermediary players is an important characteristic, we think, of this story, which is why I think it's interesting to go through this history of this sector, which Kaushiki will be doing as soon as I am done with the first few slides. Now, very quickly, how does microfinance relate to financial inclusion in the Indian setting? Financial inclusion has been a well-recognized challenge in India, not just recently, although recently the amount of attention that it's getting in the policy circles has been very, very strong. But even if you look at the policy discussions going way back in the 60s around bank nationalization, there was a famous committee, Tandon Committee report, which looked at the state of banking in India and pointed out certain things. And I believe even before that, this fact that financial intermediation was really uncomfortably restricted to South Bombay, right, was a feature that was marked and commented upon repeatedly by policymakers. But attempts at financial inclusion since then and even now have largely centered around banking. So the view was always that, well, in order to get financial inclusion, banks are our vehicle of financial inclusion. How do we expand banking services and have banks reach out to this entire country? So you can look at various steps in the history of banking in the country also being at least rationalized by financial inclusion arguments, which included the nationalization, the two phases of nationalization, 1969 and 1980. Financial inclusion was not the only reason why banks were nationalized. There were lots of political and economic reasons, but financial inclusion was one of the stated objectives of bank nationalization, saying that, well, if we nationalize it, it's going to really reach out to the people. to establishment of regional rural banks in the early 1970s, saying that the commercial banks are not doing what they are supposed to do in terms of reaching out to people. Should we have specialized subsidiaries of commercial banks called regional rural banks, which would engage better with the rural population? Now, in the policy discourse in India, the three things of rural, poor, and financially excluded are often used in an interchangeable manner, and which is growingly, at least now, I don't know how it was in the, I think it was a bit of a stretch even in the 60s and 70s, but right now those three things are very different. The rural, the poor, and the financially excluded are not necessarily synonymous, but it's very easy to somehow lose the distinction in the policy conversations. But by and large, it is probably true that it is true that the rural incomes are lower. The average rural incomes are lower than average urban incomes, obviously. But the other thing which is also a stereotype is most rural is agriculture, which is also not true anymore. I mean, there is documented evidence that more than 50% of rural incomes now come from non-agricultural sources. But this idea of serving the small farmer as the benchmark of financial inclusion has been something which has been a continuing theme over the decades in the Indian thinking of financial inclusion. So the regional rural banks experiment is particularly important from that point of view. Now, having done bank nationalization in 1969, 8 years later, the Indian government found out that even nationalized banks were not doing anything that their private counterparts were not doing before. They were just not reaching out to wherever they ought to have been going. So there was this 1:4 licensing rule that came in, which was saying that, well, a bank is going to get a license to open a branch in a metro area only if it opens, or an urban area, only if it opens 4 rural branches. So an incentive to push banks to go out into the villages and to serve unbanked regions. That did give rise to a jump in rural bank branches, but neither the regional rural banks nor the expansion of the branching networks for banks really ever got India scaled. Right? The amount of scale that is needed to make a serious dent to the inclusion problem, none of that really happened. And the reason for that is not very hard to find. I mean, if you look at the expanse of India, India has at least around 625,000 villages. Of course, what counts as villages is a subject in itself. It can be a small hamlet to a collection of habitations of 2,000, 3,000 in size. So that's a big range. But by terms of census definitions, there are 625,000 villages. If you look at bank branches in the country, all bank branches and the rural bank branches, there are about 30,000. RBI will say there are 30,000 rural bank branches. So you've got 30,000 rural branches to be spread over 625,000 villages. It's a very thin branch network to spread around. To that you can add another 18,000 or so of these regional rural bank branches. Even that doesn't change things much. Right? Even if you think that there are about 50,000 bank branches, you've got 625,000 villages to spread them over. And if you think of post offices, well, that's a bigger network, about 175,000 post offices, but not all of them are in rural areas, of course. Many of them are in cities, but a wider network. And once again, as in most other countries, post offices do play an important role in financial inclusion in India. So the point here is that the ambition of taking bank branches to cover the entire expanse of the country and the population is an uphill task. There are just too few bank branches and too many people and too dispersed all over the country. So the financial inclusion endeavor over the decades, however, has been struggling with this issue. How to really deliver financial services to the rural, agriculture, whoever, the financially excluded folks. Now, in 2004, there was a new government, the UPA government, the Congress-backed government came to power in 2004, and in the wake of the fall of the previous government, which was doing well in economic growth terms, a surprising defeat. So the new setup came and said, well, we have to talk about social equity without sacrificing the growth side. So they coined this slogan of inclusive growth. And a very important part of that inclusive growth agenda was financial inclusion. So financial inclusion sort of got in more prominently into the public and policy discourse from 2004 onwards. But once again, the thrust in financial inclusion remained focused on banking. But now it was a different approach, because now it was already conceded that it will take us forever if we want to take these branches to every village. That's not going to happen. So let's think of other innovative ways of taking financial services to the financially excluded. And the new ideas that were being toyed with were this concept of branchless banking. How can we take banking without branches? The idea of business correspondence came in, where you could get an agent who could operate within a 30-kilometer radius of a bank branch and take banking services to the doorsteps of customers. Mobile banking doesn't, and by that I don't necessarily mean just the mobile phone banking, but it could even be a van with an ATM machine driving around the place and visiting a village chalk or village market at a designated time and providing banking when branch couldn't reach there. And the whole idea of no frills banking, very basic, no minimum deposit banking, all of these innovations were tried out. But as you can see, I mean, whether we are talking about 1960s or whether we are talking about 2005 to 10, the thrust of financial inclusion strategy in India remained with banking. Now, whether you want to do it the old style branch network way or the new style technology and contracting innovation way, but it was still about how to reach out banking services to people. Now, parallel to this and in consonance with this, because banks do play a very important role even on the microfinance side, the microfinance part pretty much developed organically. It did not come out of a policy intervention. And the microfinance sector in India is probably the world's largest microfinance sector in terms of number of people involved, the number of clients. But within the country, it is only one element of the overall financial inclusion strategy. The genesis of microfinance happened in the NGO private space. Started off with development organizations, the social service type organizations, and then slowly moved into pure private sector, even profit-seeking private equity coming into play. That's an interesting story which will have its own political fallouts, which Kaushiki is going to tell us. But this is a debate that we have seen unfold in many parts of the country. Mexico has gone through it. I think Indonesia has probably also seen some parts of this thing. Bolivia has gone through it, and the same thing enacted in a pretty dramatic manner in India. Now, once this developed in the NGO and private space, it was adopted by the policy circles as well. RBI adopted it through its National Bank for Agriculture and Rural Development, NABARD, which sort of adopted this model. But one of the major mainstreaming of this came by the Chief Minister of Andhra Pradesh, Mr. Chandrababu Naidu, who did this in the early 1990s, and very soon Andhra Pradesh emerged as the key state where much of microfinance activities was going on. So this linking of banks to the self-help groups, the Grameen type model, typically of women, about around a dozen women forming a self-help group and getting funded by banks, brought this innovation of microfinance into the mainstream policy and financial inclusion strategy. Around the same time, microfinance institutions, MFIs as we call them, were experimenting with many other models. So the SIG was not the only model of microfinance that was going on. In parallel, other models of joint liability groups and even individual lending was being experimented with. So these two models developed side by side. Now very quickly, the size, the level and growth. These are the statistics of the growth part. What is interesting, what I would like to point out is that the self-help group, which is that second bar there in all of these figures, well, that was the dominant figure there. But you also have the MFI model making a rapid rise over time. These are the growth rates here, and what we see, a very strong growth rate, taking a sharp fall after 2010, which is a result of a particular regulatory crisis which happened in Andhra Pradesh in 2010. But then again going back up. So it seemed in 2010, after the crisis happens, and Kaushiki is going to give us the details, but when that crisis happened, it seemed like the end of the world for Indian microfinance industry, but the sector has taken it on its stride and sort of moved forward. So if you look at the microfinance in MFIs, their borrowers, numbers of their borrowers and their portfolio outstanding, it took a dip around that 10, 11, 12, that place when the crisis hit, but then it has made a smart recovery since then. So the sector is alive and thriving. A similar growth, similar things, but similar growth you would also see in the SIG lending. So the two patterns, the self-help groups and the MFI models, both have been on a growth path, and the numbers are gigantic in terms of sheer absolute magnitudes, but still probably not large enough for to make a big dent on India's financial exclusion problem. But the numbers are there. The other part that I wanted to highlight was the geographical spread. Now, by and large, microfinance in India is largely a South Indian activity. Andhra Pradesh is the hub of all microfinance activities, number one, followed by Tamil Nadu, which is a neighboring South Indian state, and Karnataka. So these three states together contribute about more than 40% of the sector. West Bengal comes in next with about 12%, and then all the rest, but not even all the rest. This is only about 10 or 11 states there. India has 29 states and 9 union territories. So it's only about 7-8 states which account for practically the entire industry, and pretty much a South Indian phenomenon. This is the microfinance institution loans, and if you look at the SHG bank linkage program, same story. The southern states account for 85% of the activity, eastern accounts for 6%, and the remainder is only a small sliver. So a huge regional imbalance in the spread of microfinance activities. Here is on the there's the self-help groups distribution. These are the districts of the country, and here is a measure of how many of potential self-help groups have actually been linked to banks. And the green color here means that above more than 80% of self-help groups in that district are already linked to banks. And as you can see, the coverage is almost uninterrupted over all of South India. Red means less than 50%, and yellow means 50 to 80% range. And much of the northern and central India still has work to do, and that is actually the poorest part of the country. South India and West India are relatively better off, and they have the maximum self-help group linkage, whereas the central and North India, and as well as the northeast states, which are relatively remote as well, that's the place where it is still not gone that well. So I think at this point I'll stop and invite Kaushiki to take over.
So as Rajesh mentioned, I will talk about basically the evolution of microfinance in India, and there have been around 5 phases in which microfinance has evolved. The 1947 to 70 period is when the government in India basically made a lot of interventions to address the financial exclusion in India. To give some context, around 1952, the data showed that about 90% of rural credit was provided by informal sources, so which basically means money lenders, relatives, etc. The share of banks was only about 1%. This changed about in the 1970s with some of the policies that Rajesh talked about, like nationalization of banks, the introduction of regional rural banks, etc. And also another important activity that happened was the cooperative movement. There were a number of cooperative banks, and it was promoted by the government, which actually were used to increase credit to the rural population. So by the time in the 1970s, the data showed that the formal sources of credit, the percentage of formal sources of credit is about 29%, although the share of banks still remained low, around 2.4%. The 1970s was also the time when new experiments in microcredit started happening in India. One of the most well-known of them is the Seva movement, which is the Self-Employed Women's Association movement, started by someone called Ela Ben Bhatt. She's a trade unionist and a lawyer who basically came up with the idea of lending to poor women, self-employed women. So in 1974, they started a bank called the Seva Bank. And they provided small loans to poor women who were self-employed. They also they took deposits. They did not go by the group lending model that was being experimented with in Bangladesh and in Bolivia, the Grameen model as well as the Banco Sol. They did individual lending, but they also gave secured as well as unsecured loans. And the unsecured loans, while there was no need for collateral, what they did was they said that there has to be somebody to guarantee that loan, a social guarantor, that's what they called it. So that was the model that was followed. Around this time also, from the government side, the NABARD, which is the National Bank for Agriculture and Rural Development, was set up in 1982, and this was basically this bank was supposed to focus primarily on the rural credit, to provide rural credit. This was basically the function of the Reserve Bank of India, which was taken over by NABARD, and also SIDBI, the Small Industries Development Bank, in 1990. Then from the 1990 onwards, the change started happening. So what happened was in 1990, India started liberalizing its economy, and it reversed many of its policies which it had earlier had, like nationalization of banks, restricting interest rates, etc. These kind of policies led to a kind of a vacuum in the rural areas for credit. So this is where microfinance institutions started coming in, and the idea started getting that there was need to provide rural credit to the rural population. So basically, what happened was there was this group. NABARD started a program called the Self-Help Group Program, which basically was providing these groups of women, of 15 to 20 groups of women with small loans, and they would be guaranteeing that the group would be guaranteeing that loan. Also around this time, there was this growth of these what is known as the NGO MFIs. which were basically legally they were basically societies or trusts or whatever non-profit companies, and they were an intermediary between these apex banks like NABARD, SIDBI, etc. And they would then be on lending to these self-help groups, also providing them capacity building activity, helping them in training, etc. of their members, things like that. That was the sector that started growing around that time. That was the private NGO MFI sector that started growing. By the time till the 2000, there were about 800 NGO MFIs operating in the country. There was, in terms of regulation, there was very little regulation on these groups, because they were seen to be kind of promoting credit in the country, and they were seen as doing development work. So, other than the basic regulation that is required of a society or a trust, there was not much regulation in terms of from the central bank, the Reserve Bank of India. But as Rajesh was mentioning, India being the country of the size that it is, the scale is very important. So it needed to scale up, and the moment you want to scale up, access to finance became a problem unless they were being, and then if they needed to go to the market for finance, they needed to be regulated by a body like a central bank, like RBI, to gain credibility. And that's when there was this growth of this non-bank finance companies, which are called NBFCs, and which are regulated by the Reserve Bank of India. And they started coming into the picture. They were for-profit companies. They were not non-profit, and they started attracting commercial investments. As the graphs had shown, Andhra Pradesh became the hub of that microfinance activity. It kind of the biggest NBFCs as well as the NGO MFIs were in Andhra Pradesh. So the NBFCs, among the NBFCs, the main ones are Share, Spandana, SKS, Microfinance, etc. And among NGO MFIs, there was Pradhan, there was Dhan. This was also so basically as is written there. The funding changed from soft loans and grants to private equity finance. There were international private equity firms started getting interested in getting into the sector, and this was the growth of the sector was extremely steep. So just to give some statistic, around 2010-11. The growth of the percentage of growth in clients for these NBFC MFIs was about 17%, while for the government-run program, the SHG's program, it was about 4%. This was also the time around in 2006 when there was a mini crisis in Andhra Pradesh. There was in one of the districts of Andhra Pradesh, where again there was issue of there was some farmer suicides, and there was some shutting down of activities, etc. But it didn't blow up into the huge deal that it happened later. This was also the time when there was this tension between NGO MFIs and NBFC MFIs started building up. Now the NGO MFIs primarily their objective was social development, empowerment of women, etc. They were not for profit maximization, and they including Mohammed Yunus from Grameen Bank has been very critical of this NBFC MFIs, and NBFC MFIs on the other hand focused on scale, and in order to get scale they focused on private markets, and of course on some profit maximization was important there. So this was also reflected in the organization that was the I'll take 5 minutes. Yeah. So basically, this was also the tension that was happening. Then the big crisis happened at the time when the crisis started with the SKS microfinance led by Vikram Akula. Which basically in August 2010 it launched its IPO. It was oversubscribed by about 13 times. However, within a few weeks of his actually floating that IPO, there were cases of multiple suicides in Andhra Pradesh, and it was all it became a huge disastrous news in the new. It got blown up in the news media, and there was like vilification of this for-profit NBFCs because they were seen as encouraging coercive practices, unethical practices in getting these poor people indebted, and there was overborrowing, etc., etc. Although the link between this suicides and this overborrowing, etc., has been fairly tenuous, but still, of course, the government came in the picture at that time because there was very little that was regulating any of this. And some say that the government came into the picture because there was a government program that was already being run, and that was kind of running at a was not growing as much as these NBFC MFIs. So their regulation was actually politically motivated, and basically what they did was they promulgated an ordinance which kind of ended up shutting down the microfinance industry for a at least couple of weeks. The repayment dropped. Now the industry is being through some regulations, and RBI has now come into the picture, and it has come up with some regulations. It has said that NBFC MFIs they've created a new category and said that they have to be regulated. They have to report to credit bureaus. They have to they have. Many other transparency mechanisms, etc., have come into the picture, so that there is some check on what is happening. As I've said here, that but finance is still a very small proportion of. It's also addressing still a small proportion of the unbanked population. There are also pros and cons of the model, etc. And lastly, what we thought that it was very important was that there's a necessity of having an enabling regulatory environment in the country before something like microfinance develops. Also, there needs to be need to see for other activities than microcredit and focus on insurance, etc., which are other financial services that are important. And scale, of course, is a huge issue. That's basically, I would end with basically that the political environment is critical for sustainability of microfinance, without which, as the story developed in India, it would just, the industry would just be reactive rather than be proactive. Thank you.